Hello, everyone, and welcome to John's retirement portfolio review for February 2024. Sorry for the delay in these videos. Again, I've had some life circumstances take place that have caused some delays, so I am going to be working over the next couple weeks to get caught up and looking forward to trying some new things, including some changes at the end of the video to maybe see if that results in more engagement in the comments, or if I can make some different content that just folks might find interesting. So anyway, let's jump into our numbers. So as always, I'm not a financial advisor and I don't claim to be one. The video that's made here does not reflect the views or opinions of my employer. I do hold a number of positions in common with John, and I have those listed on the screen. And this is a real portfolio with actual shares being traded. It is not a practice portfolio or play money, and that is part of the reason why I include so many screenshots, so that folks can see that this is actual trades being made. And again, it'll take me probably quite a while before I end up finally making just a side video to explain this, but John and Jane were being taken advantage of, in my opinion, by their financial advisor, and after talking it over with them, they decided that they wanted to take control of their own investments, and basically I offered to help them as long as they were willing to let me write about them anonymously, so that way we could hopefully help others who are in a similar position, who maybe don't have someone like me that is willing to work with them and help them without charging them. So for John and Jane's background, John retired in February of 2018. Jane retired in the beginning of 2021. Both of them are collecting Social Security, and currently they are collecting $1,700 a month from the taxable portfolio and $1,106.17 a month from John's traditional IRA. That $1,106 or the extra $106.17 a month, that was the increase to account for the RMD that John is required to withdraw. So that's how we arrived at that number. They do have a number of investments outside of what I help them with, but they do not have any debt or monthly payments other than basic recurring bills. So I always like to say that they make my job extremely easy, in the sense that they live very frugally, and that makes it very easy to manage their cash flows. So for the headlines, traditional IRA generated $806.15 of income, and that compares with just under $797 of income in February of 2023. And then in the Roth IRA, it generated $557 of income, and that compares with $646 of income in February of 2023. So up just slightly in the traditional IRA, and then down actually considerably in the Roth IRA. And the big thing there is that there's a lot of shares that are no longer held, that were generating some of the dividend income that was coming through. So really what's happened here is that it's just been a shift from income that was being received in February to now being received in other months. So we'll kind of go through that when we look at the other tables. In the traditional IRA, there was a balance at the end of the month of just under $345,000, and that compares with just over $357,000 in February of 2023. And then in the Roth IRA, there was a balance of $218,000, and that compares with $209,000 in February of 2023. So down in the traditional IRA, up in the Roth IRA. No companies have increased or paid a special dividend during the month of February, and no companies decreased their dividend payout in the month of February. So for the trades in the account, the IRA was actually, I shouldn't say it wasn't busy, but there was a number of trades that were made, all of which were buys, as you can see on the screen here. And so we had John Deere, and then added Black Hills twice, and then Avista, BP, Columbia Banking System, and then WP Carey. And then in the Roth IRA, there was two trades there. We had the sale of Westrock. I noted in my article on Seeking Alpha that this was an example of one where we trimmed it back too early. Hindsight's 2020, and it is what it is. But we were also, during that time, able to add to the Apple Hospitality, getting it at under $16 a share, which to me is a great entry point. In the February realized gains, since there was no sales made in the traditional IRA, there's nothing to report for the month of February. And then in the Roth IRA, because of the sale of Westrock, as you can see here, wasn't a big gain that was made. There's still this was about a third of the position that had been trimmed back, and it was primarily because these were the higher cost shares. Now the share cost basis is even lower. I want to say it's close to the like $30 to $32 share range without looking right now. So anyway, again, sold out a little bit early, but really this was mostly just to eliminate the higher cost shares in that position. And then if we look at the year-to-date numbers, you can see that the portfolios are essentially flat year over year. So even with the sales that have been made, it's been basically about a break even, or at least that's been the intent behind the sales, is to trim back positions and come close to about a break even marker. And then for the February year over year comparison, the thing that's nice here is that when we start the beginning of the year, you can see that the holdings essentially that are showing are identical. The only difference really ever comes anymore now when we have CDs, but I have that marked where it's just CD income instead of showing the individual CDs, since those turn over a little bit more often. But what you can see on here is basically I was getting ahead of myself. The Roth IRA is the one that has the shares no longer held, but you can see that there's also some timing differences here. For example, QYLD didn't pay out in 2023, but it did pay out in 2024. Again, there are some things that are just timing related in terms of when the dividends hit. February is not a month that I'm concerned with, because it's a light income month and compared to other months. So I do expect more fluctuation to come with it. So pretty substantial. I don't know where that second bullet point came from. There isn't a substantial difference. Anyway, so back to it. It's just timing. Sorry, we're just going to move on. And then in the Roth IRA here, what you can see is that the shares no longer held in 2023 made up a huge amount of the income that was coming in. And this was because at that time there was a large number of shares in General Dynamics and also the Rhythm Capital Preferred Series B. So that's what made up this $286.76. So just know that part of the reason, again, moving forward happens to be that these two paid out in the month of February, and that's now no longer the case. If we remove this and then consider the fact that now we have CD income and then increased income, or at least a pretty substantial increase in the income for UTF, we would have ended up seeing a higher payout essentially once this has been removed. So we'll see that reflected in the future months. In this case, like when May rolls around, August, and so forth. And then the year-over-year full comparison, again, already went over these numbers here, but the more interesting ones to talk about is that the estimated income deficit, because this is the most conservative numbers possible. These numbers here, when I'm projecting these, is really saying if we saw the worst possible case scenario. So I always like to start where it's at the deficit, and then as the year goes on, we should actually see it get into the positive, or at least obviously get more on track to what is really going to happen in terms of how much growth there's going to be in the income. But the deficit was originally at 6.6% at the end of January for the traditional IRA, and now it's sitting at 7%. So it did get worse. And so when you think about that, even though the income was higher here than it was in February, what that means is that we were actually projecting a higher income in February than what we actually received. And again, part of that can go back to timing as an explanation for that. Now with the Roth IRA, the estimated income deficit was at 5.8%. Negative 5.8%, and now it's sitting at 7% as well. So basically, we saw a bigger decrease in the expected income that we were looking to get in the month of February for the Roth IRA than what we had in the traditional IRA. Now, if we combine the average monthly income in 2023, it was came in at $2,259. And then that compares with an estimated $2,110.93 of monthly income in 2024 based on the current numbers that we have. For the account balances, traditional balance, IRA balance is down slightly, and the year-over-year deficit has decreased though. So when you look at the deficit between January of 2023 and 2024, that deficit has decreased significantly, even though it went down in 2024 for February. But that deficit's much smaller now. The Roth IRA balances are up slightly year over year, and the difference between the two has improved quite a bit. So you can see in January there was actually a deficit, and now it's significantly in the positive in comparison to what it was. So even with the lower starting balances in 2024, the average account balances are still greater on average than 2023 for both accounts. So for that, I'm looking at these bottom numbers here, looking at where are we at for the average so far in 2024, where were we at for the full year of 2023, and then the same for the Roth IRA here in 2024 as compared to 2023. John's traditional IRA balance does not factor in the $12,212.34 of cash withdrawals taken between now and February of 2023, and would reduce the difference from negative $13,000 a year over year to a nearly break-even number. So what I mean with that is that if we were to factor in the withdrawals that have been taken out with regard to what the balance is currently, the addition of the $12,212.34 on top of this number here would end up making these numbers almost identical. So for the 6-year, and sorry, actually this is the 7-year traditional income comparison, first off, start with the fact that take it with a grain of salt. Again, these numbers are extremely conservative in the way that they're being projected. So the number we're using looks at only dividend income and is not factoring in any interest earned from CDs and money markets, which are now becoming a much larger part of the income that's coming in. Income has grown at a cost of average goods returned of 10.67% since inception, and that's even with the setback of what happened in 2020 and 2021 of the reduced growth here. Includes a pessimistic reduction estimate of 7%, and sorry, this should be a negative 7% for FY 2024. So basically, even when we factor all of this in and we say what the year-over-year growth has looked like, we're at about 10.7% year-over-year, and that is assuming that we ended this year at negative 7% income growth. And then again, 7-year for the Roth IRA income comparison. 2020 and 2021 were setback years due to dividend cuts related to COVID. This portfolio had a number of real estate investment trusts that experienced reductions or even a couple of them had eliminations of the dividend. And so that's part of the reason why we see such a heavy setback in terms of income, and also part of the reason why we see such high growth shortly after. So for the income, it's grown at a cost of average goods return of 9.1% since inception. Again, that even includes the setback of 2020 and 2021, and includes the pessimistic reduction of -7% for full year 2024. So as we see this number normalize more, and you'll see at the end of this video what we expect that number to end up being, that's going to increase the cost of average goods returned, because obviously right now that is weighing the number down. So for the cash balance comparison, cash balances do not reflect investments in CDs and money markets. This is literally just looking at the cash that is liquid and held on hand. John currently has $25,000 in Charles Schwab money market and in CDs, along with $17,100 in cash that's on the sidelines as of April 5th, 2024. And the goal with cash on hand is make sure you have enough on hand to take advantage of buying opportunities when they arise, but not so much money that you're letting it sit there when it could be earning a better yield in something like a money market or in a CD. And then for the Roth IRA, similar situation here. Obviously, it does not reflect, cash balances don't reflect CDs and money markets. John currently has $40,000 in CDs and $9,500 in cash on the sidelines as of April 5th, 2024. And again, goal is to take advantage of buying opportunities without having too much cash on hand. And then the unrealized gain loss comparison. So traditional IRA gain loss has bounced between positives and negatives for the last several months now. For additional perspective, almost half of the previous year was in the red for the traditional IRA in 2023. And then another thing too that I'd added on the previous video was that the $7,200 in realized gains in 2023, if we were to have factored that back in, that would have brought several of these months either close or near where it would be a positive unrealized gain. And so one of the reasons why I wanted to discuss this was because, went too far. One of the reasons why I wanted to discuss this is because it's really important to understand that someone can show you that their portfolio is performing well, and one of the ways that they can do that is by selling off their losers and then showing you how much unrealized gains they have when it comes to their winners. And so when you look at the $7,200 of positive realized gains, part of what that tells you is that the portfolio performance that you're seeing here is actually what's left over after $7,200 in gains have been taken off the table. If this was something where this was a negative number, then that would actually have the opposite effect, where you could look at several of these and go, okay, some of these would have been even more in the red, or like in this case, would have been where, yeah, it was in the positive, but now it would have been in the red. Had this been a negative $7,200 in realized losses. So again, just a really important thing to distinguish, because I find that there's a lot of people online that like to boast how well their trading, day trading is going. But the thing is that they aren't showing you these kind of numbers here. They're cherry picking what they want to show you while hiding something else. And so I want to make it 100% clear. We're demonstrating that we aren't hiding poor performance by selling off major losers. In fact, the opposite is actually happening. We're taking some gains off the table, and we're showing you what looks like performance that isn't as good once you factor in the gains that have been made. So for the Roth IRA, it's been negative now for the last 12 months. But in a similar fashion, there was about $4,000 in realized gains in 2023. So again, that would have changed a handful of these to where it would have been a darn near break even point. So again, just another example of why it's important to consider that number. Now, for the traditional IRA withdrawals, John's been taking the withdrawals since 2022 at $1,000 a month, and then we just increased it because now in order to make sure it's satisfying the RMD. So even though the amount has been increased, the traditional IRA is estimated, again, this is the conservative number, to generate $1,319.63 a month of income. So what that tells you is that there's still another $213 a month of income that's coming into John's account that John's not drawing out, that he could choose to use if he wanted to. So being able to live on less income than your portfolio produces is the best way to ensure the longevity of your traditional IRA, in terms of having money invested and tax deferred. And then basically that RMD, assuming the balances remain high, is going to continue to increase. And at some point, it's going to increase beyond the level of income that account is generating. And then that's when you're going to have to start selling some of your positions in order to come up with the funds that are needed in order to actually meet your RMD. So really, it's just a fancy way, all of this is just a fancy way of saying that this portfolio generates more income than John draws from it. Oh, I didn't go too far. So for the traditional IRA, the gain loss here, so again, this is just a way of being able to show the good, the bad, the ugly. And so on here, I think I'm not sure what's up with all the bullet points. I'm sorry, I'm in just a kind of a goofy mood tonight. These numbers, by the way, these were updated yesterday. It wasn't March 9th, it was April 9th. So I promise I will do a better job on the next video, but this getting caught up things not going as well as I'd hoped. Anyway, hopefully I haven't lost trust in me yet, and hopefully this is a little bit humanizing. But basically on this portfolio, current yield is at 4.79%. Part of the reason why that's slightly lower than what's expected is because down here with Charles Schwab Money Market and then with the current Washington Federal CD, because these are especially with the WaFed CD, we're not counting the future income because of the expiration dates that come with it. So basically, in a nutshell, the yield is reporting lower than what it actually is, because we are wanting to be a little bit lazy and not have to calculate out those numbers or go to the exact expiration date when projecting what that income is going to look like. So just know that this is a more, again, conservative number. We have Bank of California, Healthcare Realty, and then Crown Castle represent the positions that are the most underwater, while Valero, Chevron, and then Main Street Capital represent the positions that have the highest unrealized gains. And then for the Roth IRA here, again, updated these on April 9th. And so with this portfolio, you can actually see that at the time that we updated these numbers, it's actually in the positive here, which is something that, if you remember the previous screen, when it comes to the unrealized gain loss, it's been in the negative for the last 12 months. So that's positive news, or at least a move in the right direction. And then, so in this case, we have Dominion Energy, EPR Properties, and then Ventus Real Estate Investment Trust represent the positions that are the most underwater. And then we have Iron Mountain, Pepsi, and Brixmor Realty represent the positions with the highest potential for capital gains. And also on the Roth IRA here, again, this yield you'll notice is quite a bit lower. And again, part of that is going to be because of the CDs here and the way that the income works and the way that the CDs expire. We've opted to just err on the side of safety. So that is why our yield is showing lower. All right, and then this is probably becoming my new favorite table, because this is what takes the conservative estimates and then actually goes and really extrapolates out and says, okay, based on the CD mixture, based on the dividend income mixture, what kind of increase are we potentially looking at in income in this portfolio? So as you can see on here, we have it broken down to where in this column here, we're saying here is how much income is made from dividend items. Here's how much income is made from things like CDs and money market. And then here's the total right here. So based on that, we have an estimate of 6.3% as the year-over-year increase in income in the traditional IRA. And if you remember at the beginning of the article, it's currently projected to be negative 7%. So that's, again, just a great understanding of just how much different the baseline worst case scenario is as compared to what is the more likely scenario to happen. But it was a small increase of 1.15% over 2023's numbers. And also, so this is down from the month of January. So in the month of January, this number here was estimated at 7.8%. That is a pretty substantial drop month over month. But part of that's going to be just, again, it's the beginning of the year, but in this case, it's the fact that it's February and it's just a very odd month when it comes to the income that's rolling in. Because as you can see up here, it's actually the only month that is projected to have an income that is less than $1,000. So it is kind of a unique month in that, right? And then for the Roth IRA here, income generated was down about just under 14% compared to February of 2023. So again, that's just looking at the month over month income. So 2023, and then what was earned total in 2024. But as you can see here, the amount of CD income is increasing, and we've since added more CDs in there. So I expect this number to go up more as well. And then also on this one, we're estimating an increase of 10.6%. And that's going to be this guy here. And that is down from 17% in January. And again, part of the reason for this is that we had a number of General Dynamics shares and then Rhythm Capital Preferred Series B shares. And that was part of what added a lot of income in 2023 that's no longer part of this portfolio. So again, February is an odd month, so take it with a grain of salt. Also, this number is going to move more in the beginning. As we get this more solidified, we'll see that improve. So in the conclusion here, and of course I'm trying to get caught up on other videos, but I think that there's some short video opportunities that I can make that might be kind of a nice break from some of these ones that take a lot more work preparing these slides for. So instead of traditional conclusions, because I just don't see the value in them anymore, or at least as much, because it's kind of the same thing, from article to article talking about the Fed and stuff like that. But I thought it'd be more fun or interactive if we could generate more conversation in the comments section. So if you've made it to the end, if you've handled my silliness during this video, I'd love to take some deeper questions or and answer those in the comments. Or if there's something where I can make a video about a stock, if someone wants my opinion on something, or they want me to kind of look at some, show them what numbers and things I'm looking for when looking at an investment, I'd be more than happy to do that. So if you have any investments or companies that you'd like me to look into, I'd be happy to make a shorter video, and also kind of help broaden my knowledge and kind of challenge myself in the process. But also, if you have any questions about your own investment portfolio, obviously, I cannot emphasize enough that I am not a financial advisor. I'm not here to give advice. But I do like taking things, looking at it from a different perspective, and again, kind of challenging my own personally held beliefs, but also maybe even bring some tools to light that might help you understand your own portfolio or think about things in a slightly different way. So I'm open to these kinds of questions or any other ones that you guys might have. And so my goal on this is that anyone who writes a comment, or asks for something, I definitely feel like I'm willing and able to respond to it, whether it be at least in a comment or in a video. Obviously, if it catches on, I might have to pull back on that promise. But just know that that's something that I would like to do, because I would like to get more engagement with YouTube, and hopefully improve the algorithm, and also just kind of expand the conversation a little bit more, because I do miss talking more in depth about questions that people have and things like that. So anyway, again, thank you everyone for handling my ridiculousness, but also tolerating the fact that I haven't been getting a lot of sleep lately. So anyway, if you do have any questions, please let me know. And thanks again for watching these videos, and I appreciate you taking the time. And again, if you made it all this way, you're the best. Much appreciated. Have a great day.